At December 31st, 2008, the balance sheet of Mecca International included the following shareholders' equity accounts. Okay, so what we see is common stock to the left of my mouse, 60 million shares at $1 par value, paid in capital in excess of par of 300 million, and retained earnings of 410 million. Now, reading to the left of my mouse, it says the requirement is to assume that Mecca International views its share buybacks as treasury stock. Record the appropriate journal entry for each of the following transactions. So on one it says on February 12, 2009, Mecca reacquired 1 million common shares at $13 per share. Okay, well the calculation we need to do, let me bring that over, looks like this. 1 million shares times $13 gets us 13 million. And the entry we need to do looks like this. We need to record a debit equal to that 13 million and the credit to cash to show that we used cash to acquire the common stock. Now let's take a look at number 2. To the left of my mouse, number 2 says, on June 9th, 2010, Mecca reacquired 2 million common shares at $10 per value. Alright, so number 2, the calculation we need to make looks like this. Okay, and now you see the calculation to the left of my mouse. Treasury stock is 2 million shares times $10, or 20 million is what we need to record. And so on that June 9th entry, we have a debit to treasury stock equal of 20 million and a credit to cash. Then on 3 it says, just to the left of my mouse, on May 25th, 2011, Mecca sold 2 million treasury shares at $15 per share. Determine cost as the weighted average cost of treasury shares. So let me illustrate that down below. Okay, now I've adjusted the screen a little bit so that you can see the work. So we don't see the top part of the screen. I've slid us down a little bit. Alright, so what do we know? We had 2 million shares at $15 on that were issued at $15 for 30 million of proceeds, and that we see the calculation there. The treasury stock, we had 2 million at $11. Well, how did we come up with the $11 average cost per share? We took 1 million at 13, 2 million at 10. We get 13 million and 20 million, so 3 million at 33. 3 million divided by 3 million shares, 33 million divided by 3 million shares gives us $11 in average cost. So the 11 times the 2 million shares we reissue is the 22 million that has to be reduced from treasury stock, so we credit it. We debit cash at 30 million, and then we have a new credit to make the entry balance, which is paid in capital on share repurchase. Now let's take a look at number 4, which says for the previous transaction, assume the company determines the cost of treasury stock using the FIFO method. FIFO method. Okay, now I've slid back up because we can get everything on the screen now. Alright, so the calculation on 4 says take 2 million times $15 to come up with 30 million proceeds. That's the same as what we saw on 3. So we've got a debit of cash of 30 million. But we have to calculate how much do we credit treasury stock for. And on 4, if we're using the FIFO method, we assume that the first one in was the first one out. So the 13 million we acquired on February 12th right here goes. All 1 million share of those go, and then 1 million of the 2 million we acquired on June 9th goes, and that was at $10. So we have a $23 million treasury cost value, or treasury stock cost. So we reduce treasury stock by 23 million, and then the difference goes to paid in capital share repurchase equal 7 million.